Welcome to Stockwatch with me, Simon Brown, and joining me to unpack your stock-related questions today, Cobus Potgieter from Southern Cross Capital, Schalk Louw from PSG Old Oak. Be sure to send your questions through email, stockwatch@bdtv.co.za, SMS 41392, or on Twitter @BusinessDayTV using hashtag Stockwatch. Gentlemen, thanks for joining us. Cobus, let's start with you. The Nedbank results yesterday, was it really all just about their guidance, which was, the tariffs start tomorrow sometime, or 6 o'clock in the morning our time. Was it about the forward guidance and the concern, and could we see more of that, or was there something else hiding in those numbers?
No, I think you've hit it on the nail on the head there, Simon. Essentially, the earnings through the regular trading updates provided by the banks were pretty well guided, more or less in line with expectation, and even the credit risk, or the so-called credit loss ratio outcome was reasonably positive. The forward-looking statement is really where the market grew concerned, and more specifically, they're downgraded from high single digits to mid to high single digits to low single digits earnings growth. So headline earnings growth. So that a little bit disappointing. The new CEO hasn't been in the position for that long, so cost control has been pretty weak, and one would expect that the new strategies trying to contain this and focus on those segments that they've identified to be attractive, and the consolidation among some of the business banking sectors to take a bit of time. And for the moment, I think the market was just pretty disappointed by that forward-looking statement, a bank that has already underperformed its peers in the market.
Schalk, we're going to see more of these coming. The tariffs kick off 1 minute past midnight. That is 6:01 in the morning, our time tomorrow. Or is it 1 minute past 7? It's early tomorrow morning. Are we going to be seeing more of these, and should we sort of be worried? Because Nedbank was quite messy yesterday.
Yeah, I think Nedbank was sort of neither here nor there. And just to add what Cobus said, it was a sort of the market reacted the way I thought it would react, because we spoiled for choice. We've got great banks in South Africa, and we've seen lately that the likes of the ABSA has restructured and improved somewhat. And when I say improve, when you look at their ROEs, the return on equities, they've actually moved up from let's call it 12-13% level. I'm talking about ABSA, and now gone close to the 16% levels. Over 15% as well. Yet they're still trading at a price to book of just below 1 times. And Nedbank came in exactly the same levels. They definitely missed, not just on the earnings side, return on equity also somewhat softer. They guided that it's going to improve close to, let's call it the 17% levels. But the market is looking at this now and saying 15% ROE, when you can get over 18%, closer to 19% on a Standard Bank, 20% over 20% on a First Rand, just better ROEs. And for that reason, I thought the market wouldn't really do or see a re-rating on Nedbank, and they got hurt. They really got hurt. The tariffs. That's going to be an interesting one. I think. We've seen South Africa being in the news quite a bit. There's quite a few countries that's still in the news that hasn't really got the, let's call it, the final verdict that they wanted. I would have thought of, or would have, let's say, hoped that we would have done more to negotiate. I know I've seen the news, and it says basically the South African government is really trying to find other avenues to sort of mitigate what they're losing on the one side. Take from Peter, naturally what they've lost on the US side, and try to make it up from other countries. I think that's going to be, it's a difficult and most probably a dangerous strategy, because over the shorter term period, the US is still let's call it the third largest trading part of South Africa, making up over 7% of our exports. If you look at that 7%, more or less, let's call it 2% of our total exports is made up just out of motor vehicles and those type of exports coming from South Africa going to the US. Now that's crazy. I mean, I was in an interview the other day where they actually talked about East London and the effect that it can have. They were talking about the motor vehicle industry in South Africa. It could cost us up to 15,000 jobs. We can't lose it. We just went through this whole ArcelorMittal scenario, losing 3,500 jobs in Pietermaritzburg. We can't lose any more jobs. I would have thought, I mean, and just to the viewers out there, when they look at this, they should know that let's take Mercedes-Benz. In East London, they make the C-Class Mercedes-Benz, which they export to the US. Now, there's a few countries in the world that actually do make these C-Class Mercedes. One of the countries is actually Indonesia. Now, just to compare the two, Indonesia went and they sent the whole team to the US. They originally started off with the 32% tariffs, arm wrestled, and eventually got the Trump administration down to 19% tariffs. Now, literally the same C-Class Mercedes going from South Africa and going from Indonesia. The one will be costing 30% more, and the other one 19% more. Guess which country is going to hurt the most? Yeah, I think it's going to be a very, very interesting, it's not just a few days, coming to, let's call it the 6th of August, but I think it's going to be an interesting few months for us as a country.
And Cobus, is part of it, I mean, there's some direct effect, and Schalk talks around down in East London, and absolutely. But there's the bigger picture, which is kind of maybe what Nedbank was implying to, which is just a global economy, which is going to see probable slower growth, less trade happening, and implications there for some of our bigger corporates as well.
Yes. I mean, just to add a little bit of juxtaposition to what Schalk's saying, I agree in terms of the bigger picture, and over the next 12 months, we will understand the impact better. But the reality is, in the short term, it's not as critical or as sort of life-threatening as all that. These facilities, I mean, the investment that's been made into automobiles, as an example, is substantial, and these companies are reasonably flexible, and also, where one market becomes more competitive, another one becomes less so, and they can shift around a little bit. And in the short term, at least, again, we are still negotiating. Around 68% of our exports to the US are in fact exempt, being mostly those metals and commodities. So yes, that auto sector is of course the major concern, along with some agricultural produce. In the current season, we will not be heavily affected. Most of that has been offshored already. So we'll see that play out. But Nedbank is a bank, and the reality is they are dependent on GDP growth. They need the market to grow for them. They can operate more efficiently. They can capture market share from their peers. But the quickest way to grow earnings is to participate in a growing economy, and that ultimately, this certainly doesn't help. And in time, it is expected to constrain global growth and South African growth, and that just leads to a less rosy outlook for the likes of the South African-focused banks.
Yeah. So let's move from banks. Let's move to retailers. We had some updates yesterday. Pick n Pay and Shoprite. Cobus, the Pick n Pay, it looked like the turnaround is happening. Of course, there's Boxer in there, and we know what the Boxer story is. We've seen the update from that. Your thoughts between the Pick n Pay and Shoprite? Are either of them looking attractive to you? Shoprite's certainly been under quite a trunkload of pressure. Pick n Pay, on the other hand, is almost free if you take the Boxer stake out.
Yes. The reality is the market somewhat rationally is pricing further value destruction from Pick n Pay, and that's the only way to look at it. I think the reality is the turnaround is a little too late. They're essentially having to walk away from their major DC investment, which is expected to provide some short-term capital debt cost pressure relief. But the irony of Pick n Pay over investing anywhere over the last 10 years in terms of their distribution. And now, given how little growth they've had, they simply don't have the floor space to support such a massive DC in Gauteng. In fact, they've been shrinking. Ultimately, that business, again, in a somewhat sideways moving economy without economic growth, I think that business will continue to bleed slowly, and ultimately they'll have to keep selling chunks of that Boxer holding to recapitalize, to keep going. So in the short term, it's certainly not dead, not by any means stretch of the imagination. It's a business with value, but it's unexciting, and it's hard to see them recapturing those margins. They're already sort of the lowest margin player in that space relative to a Spar or a ShopRite. ShopRite on the other side, excellent execution, again operating in an environment that is a little bit sans growth, and we're seeing this is a fantastic trading update. Just 60/60 continues to add, the run rates of 50% growth inside of 60/60 has been half year after half year after half year after half year. It's just 50% all the way. Fresh X being rolled out to the lower tier stores as well. So these guys are doing an absolutely phenomenal job. However, the economy isn't growing. I think this is probably quite a nice entry point. It's the cheapest it's been in a long time, and I expect them to continue to excel and take market share away from their peers. But again, those revenue top line headwinds, despite the good execution, despite excellent margin control, that will be a bit of an overhang on them in the short term.
Yeah, imagine a 2 or 3% GDP. I mean, forget 4 or 5, 2 or 3, what we could do. Schalk, we got a minute and a half to break. ShopRite in those 250s, I mean, it's been up 320 late last year. Surely ShopRite in the 250s must be attractive. It's PE historic of around 20.
Yeah, I mean, I'm not going to go into ShopRite again. I mean, I had it as my stock pick for last week for good reason. I mean, forward, if you look at the historic PEs, run about the 90s, it's always been at a high valuation, current trading at one of the cheapest levels ever. But I mean, just to finish off what Cobus said, I mean, looking at the market share, I mean, I run let's call it a data point over the past, let's call it 9 years, where every year I look at these different retailers, ShopRite, Pick n Pay, Woolies Food, Spar, now you can add Boxer as well. And you specifically look at the South African revenue. And you'll see that, let's call it 2016, ShopRite was having run about, let's call it 38% of the total market share, while Pick n Pay was just short of 30%. Now when you look at the current levels, and I'm excluding Boxer now for this calculation, 47% going to ShopRite and 24% to Pick n Pay. Wow. The one company is in an expansion innovation process. The other company is still focused on recovery. You need to decide which one you're going to take.
Gents, a question coming through. Best way to buy China? Is it just to buy Naspers, or could we get more clever with it? Cobus, I mean, firstly, do you want to buy China? And then what is the easy route on the JSE, or perhaps off JSE even?
So the sort of simplest way to do it would be an Naspers for a process, of course, but there's another listed stock on the South African Stock Exchange, the Satrix China, STXCHN. I quite like that vehicle. You're taking direct exposure to the MSCI China index. You're still getting your largest holding in that ETF is still, in fact, Tencent. It's around 17%, which I guess is better than 100% that you're getting via process. But that's a great way to play it. As just keep it simple. The Hong Kong listed stocks are reasonably accessible if you have an IB or an IG or no free ads, a stockbroking account. But if you want that exposure, that's the way to do it. I still like it. We've actually launched a fresh fund and couldn't get couldn't get the FICA sorted out in time to get those offshore accounts, and ended up taking STX China, the Satrix China exposure. Worked out very nicely, and it's been one of the best performing exchanges over the last 12 months, and I still like it at this level. The sort of reflation thesis within China, and of course a little bit of AI exposure at the top of that index, still reasonably attractive.
Yeah, and those ETFs they're nice and they do what they say in the sticker. Schalk for you, some China?
Yeah, I don't to repeat what Cobus has said. I mean, that Satrix China is definitely a good choice. I mean, for the pure reason where when you buy the likes of a Naspers process, which I do like. I mean, just let's not for the pure and simplest way of buying into China. I would say Naspers process is a good call, but you are exposed to Tencent. I mean, that's pretty much it. And it is the largest holding within the Satrix China as well. But you've got a few other great mega caps in there. I mean, the likes of the Alibabas, and I'm going to pronounce it incorrectly again, but it's Xiaomi, these Ping An. I mean, it's a great diversified portfolio in China. China is an interesting one, Simon. When I like looking at my different ETFs where I compare them, and the one that I've been finding quite interesting up to the end of last year was the US tech companies relative against the Chinese tech companies. So there's both of them got ETFs, and there was a massive underperformance up to the end of 2024 for good reason. I mean, we know the likes of NVIDIA's and Microsoft's; those companies really did extremely well. And I said tech companies, I actually meant internet companies. But let's just say since November last year, we've seen a massive retracement. Not that the US internet companies really did badly. We know that they struggled around about the April tariff mark, but since then they've done pretty well. But these Chinese internet companies have done phenomenal, but they're still lagging. I mean, when you look at it the past, let's call it 3 to 5 years, they still lag the US counterparts. So yeah, would I initially be selling my Chinese companies at these current levels? No, I still think there's opportunity.
Yeah, absolutely. You also get Contemporary Amperex Technology Co. And I know about that because I've been digging. They make batteries, but batteries that go in EVs. Schalk, let's stay with you. Let's look at health. Question coming through. Netcare or Life Healthcare? Keen for some medical, but not sure which, or maybe I should just pause and stay away. Schalk, would you be looking at healthcare in either of those two in particular?
Healthcare in general. I mean, we've seen internationally that's it's been a sector that's now been talked about again. It's always been a great defensive play. But both these companies seem to be, I mean, we know Life Healthcare, they've done some restructuring there, sold a few of their businesses, and look financially, well. If I had to choose one of the two, I would have most probably said I'll take a third option, and I'll go for Remgro. And not to be difficult, but Remgro,
sure.
More than 30%, let's call it 33% of Remgro is Mediclinic, and they've really shown some great restructuring lately. And by buying Mediclinic, or let's call it Remgro at these current levels, you're buying all these, let's call it underlying, and not just Mediclinic. There's companies like Discovery in there, and you're buying it at an over 40% discount to NAV. So to the listener out there, I think healthcare in general is something that I do find attractive at these current high market levels. But go and have a look at your Remgros. Don't throw away the Mediclinics. Mediclinic is still there.
Yeah, I take your point. And you get that discount to boot with it. Cobus Healthcare for you?
These companies have been value traps.
Yeah.
So like to try and sort of call and again, part of the issue is the number of insured lives have gone sideways for a number of years now. Amongst the two, I prefer Netcare. They've refocused on sort of offloading the so-called network business. We've all heard Delta Core and whatever when your broker chats to you about your medical aid options, whereas Life have doubled down on network business. Non-network business is far more lucrative. So essentially, Netcare are trying to right-size the business. They've also gone into a digitization program a lot earlier than either of the other major players, and we should see some excellent cost control coming through off the back of that process in the next few years. So just I think well positioned, and if there is some insured life increases in South Africa, I think they will be the best position to benefit, and of course have the highest ROE performance in the process.
Yeah, I get your point on that. Let's go to kind of in the same space. Discovery, is it worth a look? So I like Discovery, but the results just, they hurt my head. I'm not smart enough to get through all of it. Cobus, is Discovery one that you are able to read the results, and do you like?
I've got precisely the same headache, and I think that's part of the reason why the rating on it has gone backwards in time. So I'll say this, the thesis for Discovery has been the same over the last 5 years, and that has been bank and Ping An, or the rollout of Vitality in foreign markets. And I think the market anticipated that too early, and that process was, of course, disappointingly slow. And both seem to be rounding the corner. We're looking at profitability in bank within 12 months. The loss is more than halved in the last year, and Ping An seeing significant growth. And on top of that, the valuation isn't nearly as demanding as before. So we typically steer clear because we prefer quality and wouldn't necessarily consider this to be quality, but at current valuation, I must say, it does look interesting, and it does look like slowly but surely they are executing on the two major growth drivers in that space. Risk from something like an NHI notwithstanding, I am discounting that somewhat because I believe NHI is more or less politically off the table.
Schalk, Discovery for you?
Again, I'm going to repeat all that Cobus said. I totally agree. And have I told you about Remgro?
Have you told me about Remgro?
There we go. So another company that you will find within Remgro. It's also, I think, make about 10% of the Remgro NAV. And did I mention the discount of about 41%? Same story at all.
Okay, so I mean, almost a stock pick, but not a stock pick, but Remgro is coming up a lot. So now we're going to go down to the bottom end of the market. Schalk, Cogro, M3 or Baldwin. The question is, South Africa needs houses, interest rates coming down. We could see some activity there. Are either of these worth having a look at? These are probably, 1 or 2 billion rand companies. Right? They are small caps.
Yeah, no. So firstly, both companies, not really companies, small caps. I'm looking at, so I won't be able to give an expert opinion on either of these companies. I can just say that I've mentioned it quite a few times before that Stats SA produce these let's call it buildings completed over periods, and where you can look at residential properties, you can look at non-residential properties. Non-residential properties is looking crazy. I mean, we're not completing the properties as we should. And I think there's going to be a shortage of stocks. I think that's one of the reasons why we've seen a massive recovery in some of these local property counters. But the residential is a similar story. We're not really completing residential properties as quickly as we should be doing either. So, yeah, I think for that reason, it could be an interesting space, but neither of these companies really attracting my radars for now.
Yeah, and they are, as you point out, these are tiny stocks. Cobus, I need to go to stock picks, so we won't ask you about Cogro and Baldwin. Cobus, Mondi is your pick today. Yes,
one of these recently reporting stocks that suffered a severe sell-off. Again, it's a materials business. They're exposed to effectively a commoditized product, and we believe this is bottom of the cycle. Mondi really lost a lot of its blue chip status in the wake of the war in Ukraine, and losing some of its highest margin business inside of Russia. And subsequent to that, has had to reposition and restructure against the backdrop of a softening price in a lot of their products. However, it does look like that market is bottoming out. Corrugated, recycled, both have started recovering nicely. Mondi is still a top quartile producer in terms of cost to output. So from that perspective, and the fact that we expect it to start de-gearing, which always adds that nice little kicker to the end of your results. When HEPS looks a lot better than operating profit growth, we believe at the current valuation, this is quite a nice entry point to get back into Mondi.
Yeah, and I just zoomed out in that chart. It was a 400 rand stock before the invasion of Ukraine. Schalk, Volterra.
Yeah, it's shiny. When it's shiny, I love it, especially now currently. I mean, we've often had this conversation. You turn a clock back, let's call it 18 years ago. You had a platinum price of, let's call it, just over $2,000 per ounce, while the gold price was trading $700-800 per ounce. Hence the fact why I always tell the story. I mean, some of these banks really need to relook at the classification, because a platinum client is still better than a gold client, yet the gold price is trading at close to 3 times the price of platinum. And for that reason, I do think that there's been some restructuring, or let's call it repricing on some of these PGM prices. I don't think it's done yet. I think these current levels are looking really good. Why Valterra? Now Valterra is sort of, I still believe, a great entry point into your PGMs. When you look at the likes of Sibanye, now remember they came off a horrible 2024. They're looking at a year-to-date growth of 162%. That's since the 1st of January 2025 up to yesterday's close, 162%. Northern Platinum, we're looking at 122%. Even Impala Platinum, 94%. While the likes of Valterra, only 58% year-to-date performance. I say that only, but remember they had a very bad 2024. Now the reason for that, let's call it lagging the other counterparts, it's not because things are going badly. Yes, their production is somewhat softer, but they are looking really well positioned. The quality of the precious metals are really very, very good, well managed. And it's the only reason was, remember, Valterra was that spin-off out of the Anglo Gold, so massive hangover of stock. So I think there's still an opportunity there. It's still, let's call it, lagging 30% to Impala Platinum, and it's definitely not an inferior company, or let's call it superior company.
Yeah, I like what you say there. And the Sibanye, most of that move is from April. Crazy numbers. That's all for Stockwatch. Thanks to our guest, Cobus Potgieter from Southern Cross Capital, Schalk, Louw, PSG Wealth, Old Oak. Up next, the close. Stay watching.